G'day and welcome to Insight Private Wealth's quarterly market wrap. I'm Sam Stillone and I'm joined today by our independent investment committee member, Dr. Steve Garth. Steve, we're back at work now. We started off 2022. At the end of last year, the Australian share market had a fantastic year. Can you give us a quick rundown as to what happened on the Australian stock market?
Yes, for sure, Sam. Well, let's have a look at this chart, and you're absolutely right. It's been a great year in Australian shares. They're up by 17.2% for the year. Now, keep in mind, Sam, that the long-term average return in the Australian stock market is about 8 or 9% per year. So a 17% return is fantastic. You will see in the December quarter, it's fairly flat. It's only up 2.2%. And Sam, if you look at the next chart, it actually shows the different sectors that make up the ASX 200. And you'll see that the biggest downward weight on the market is actually financials. As you know, financials make up about over 30% of the Australian market. So, and you can see that the financials are down in the last quarter. So that's pulled the rest of the market down. And that would be due to the surfacing of the Omicron variant.
And the same sector, though, was the best performing sector across the full calendar year, though.
And that's right, Sam. So when you look at the full year, the Australian banks have had one of their best years for quite a few years. They're up anywhere between 15 and 30%. So it's been a very strong year for the banks, and that they really have led the market, both over the year and over the quarter.
And what about the, comparing the Australian share market to more global equity markets? Have we seen similar sorts of results across various regions there as well?
Yeah, we have, Sam. So despite rising inflation worries and a global supply chain crisis and the uncertainty around the pandemic, global markets have reached new highs in 2021. The US market, for example, is up by 35% in Australian dollar terms. And if you have a look at this chart, if you thought 17.2% was good for Australia, then the developed markets are up by 29.6% for the year. And in fact, they're up by just over 7% for the quarter. So the developed markets, very strong. Emerging markets, not so much. They are negative for the quarter and a fairly paltry 3.4% for the year. And the reason for that, Sam, is just due to the economic slowdown going on in China. The Chinese market is down by 18% for the year, and China makes up about 40% of the emerging markets. So that's why you see the emerging markets having a tough time.
Yeah, it's acted like a real anchor to that sector. What about the bond market there, Steve? Because the Australian bond market hasn't fared too well over the last 12 months.
No, that's right, Sam. So we mentioned, of course, that the twin themes of the year and of the quarter have got to do with the pandemic, but also the thought of rising inflation or higher inflation. So when the market starts sensing higher inflation, bond yields go up. When bond yields go up, bond prices come down. And so you'll see in this chart, Sam, that both Australian bonds and global bonds are negative for the quarter and the year. That might surprise people, but it has happened before where bonds have had a negative year. And it should be kept in perspective that equities have had this fantastic year. So in a balanced portfolio, you've still had an excellent outcome. And remember, the bonds are in the portfolio not to drive the returns, but to protect the portfolio should the equity market fall over.
Yeah, that's exactly right. And you mentioned inflation there, Steve. So there is a fair amount of talk at the moment in the press about inflation and the potential effects on interest rates increasing progressively over time. Can you maybe enlighten us a little bit more on that area?
I suppose for most of our viewers, inflation is not so much of a concern. You know, inflation's normally a good thing because it leads to wages growth, and that's normally how a good economy functions. But what people are most interested in is on interest rates, because that affects both, retirees as well as, the accumulators who have got mortgages. Now, in Australia, despite the rising yields and their long-term yields, the RBA have come out and said that they're really not planning at this stage to raise rates this year. So the first rate rise will be early 2023. That might change, but that's what the RBA are saying at the moment. And if you look at the chart here, Sam, we've sort of plotted out, if you like, what the economists, what their best estimates are of the Australian interest rate cycle. And you'll see, even going right out to 2024, we're not expecting interest rates to be much more than, 1.25%. Again, the green shading there does represent this bit of room for error there, because it is a forecast, of course. And the last thing I'll say, Sam, is that you'll hear a lot about US interest rates, because financial markets always talk about the US. The US will be raising rates, or we expect them to be raising rates this year. But here in Australia, we're not expecting any rate rise until 2023. And even then, it will be a modest and slow rate rise.
Yeah, look, I think that the Reserve Bank has done a great job so far in terms of its communication piece, and so long as that communication continues as we expect it will, rate rises aren't going to take markets or investors by surprise. So, and clearly these historically low interest rates have to return back to a normal level. So, if they do start to increase, it's actually a positive sign. So, look, thanks very much for that, Steve, that recap. We look forward to catching up with you again in the next quarterly investment market wrap. To everyone at home, thanks again for joining us for a wrap up of 2021. We look forward to seeing you once again over the next 12-month period, and wishing you and your family all the very best for 2022.